Okay, I'm sure a few people will be rolling in here as we get started, but we want to keep everybody on their schedule today. So again, thank you very much for joining us for today's webinar on Q2 results. Excuse me. Thank you again for attending. Just a couple of reminders. One, we will send out a copy of the presentation and a link to the recording later this week. So in case you have to break away, you'll have that. Secondly, we are in listen-only mode, which means you can hear us, but we can't hear you. So certainly if you have a question during today's webinar, submit it, and we will take those at the end of the call. Just a reminder, at QwickRate, we continue to try to evolve. We've added new offerings, including QwickAnalytics, which many of you are users of. It's the basis for a lot of the information for today's call. We also introduced in 2019 IntelliCredit, a credit review division headed up by David Ruffin, who will join us on the call today. So we're thrilled to have David join our QwickRate and QwickAnalytics team. He has an extensive bio of experience. We are pleased to not only have him to head up this division in our loan review offerings, but he helped develop some software that includes a portfolio and analyzer and even some software on smart loan review to make that process more efficient. So you'll hear from David today, but again, welcome, and certainly if you haven't reached out to him, please do. We're going to talk about a number of things today. One, we'll just start with what's happening in terms of performance numbers through our QCBI, the QwickAnalytics Community Bank Index. We'll talk about just some of the surreal and the surreal times we're living in, and then we'll touch on some current credit issues and talk about next steps. So again, the size of the industry continues to drop. We're right at about a little over 5,000 banks. Our community bank index, is based on the FDIC's definition of a community bank. One of the things that we repeatedly talk about is we want you to have the ability to see what's happening within the community bank universe. Oftentimes the FDIC information really tells the story of the largest banks. Sometimes they're the same, but we always want to filter out where we can. You can see here one of the things that's happening as we're consolidating is the bucket of banks between 100 and 500 million kind of continues to grow. And you can see we're right at about 50% of the banks in the country are between 100 and 500 million, which is kind of an interesting, occurrence. Now, they only hold about 20% of the assets, but, we are like to say, community banks have always and will always have a presence in the banking landscape, and we are trying to always provide you with tools to make you the best bank you can be, and that's true again here today. These numbers are last 12 months numbers, but you can see the quarterly numbers here for 6/30 had a huge spike up in asset growth. You will see those. Those are partially explained, obviously, by the front loading of PPP dollars that came into the banks and PPP loans that will show up in the next slide. So tremendous asset and loan growth here in the second quarter. You can see almost half the banks in the country had over a 10% increase in loan growth. Again, a lot of these are PPP loans or SBA loans, but a lot of activity here in the first half of the year, which is, again, not always something you think of when the country enters into a recession. Deposit growth has remained strong, again, partially explained by the fact that, banks and customers receive their PPP dollars in advance with the expectation of keeping employees on the books. So that there wasn't an immediate draw. They're drawing that down, obviously, now. That's why they're talking about another round of support. But a lot of those, dollars came into the banks, and then have been slowly leaving the banks. So we'll continue to monitor those deposit numbers. From a performance point of view, obviously with rates moving to zero, it's not surprising that, yield on loans have fallen for us in the industry. We've seen a pretty, equal drop, larger drop in cost of funds. I would remind all of you to, as much as you may want to continue to overpay in your local market, one of the byproducts of what's happened here is the wholesale markets are extremely cheap, in ways that we haven't seen in certainly over a decade, and even approaching, haven't seen in the last 25 years. So, I don't overpay in your local market if you need money, because there's a lot of wholesale money available. Net interest margin, which is going to again continue to be a challenge as we move forward for banks through this environment, dropped. And, again, I think the fight will be to try to hang on to margin while not giving up too much market share for most banks. And then you can see the numbers for non-interest income and efficiency ratio. Pre-tax ROA, again, we have a lot of conflicting, or, what feels like conflicting times. Again, the drop in ROA and core operating earnings, and that's what these numbers represent, core operating earnings, which is really a pre-provision type of analysis. So it's, it's before credit-related and non-recurring items. We think this is a great way to compare banks. This actually rose. And you can see over here to the right, based on asset size, banks of all sizes, exclude in some ways the 0 to 100 banks, but every bank is really, driving really good, solid earnings right now, which is great to see for all banks, but certainly community banks. ROA just rolled over a touch, and then you can see the ROE numbers are virtually flat from last year. So again, on the one hand, we think COVID-19, we think of all these crazy things, we think about potential overhang and recession, and right now it's been mitigated to a point by a lot of the relief. And I think as we think about 2020, and I always kind of think of the irony of 2020 vision, where you have perfect vision, and in the year 2020 we have anything but perfect vision. I think the reminder of where we are going as an industry really is in the simple statement that the Fed has said in this release, but repeatedly, that the path of the economy is going to depend significantly on the course of the virus. There is no way we accelerate as an economy until we get control of the virus. Many think that will come with the vaccine. That will help, but I don't believe it's a silver bullet or a panacea. So we have to kind of continue progress being made with the virus. I think it's very interesting to note this time around, we at least have gotten immediate fiscal response, regardless of the bickering and the partisan politics in our country. We have come to the defense of the economy in a way we did not see last time. If you think about the response here, you can see the spike up in deficit spending that we have put into the market. It partially explains why the effects to the economy haven't been as dramatically negative as they were last time, because you can see in this graph the peak dollars that went into the economy last time, which was only $800 billion, almost took 2 years from the point where recession happened. This time it took less than a year, and in some ways less than 30 days to get response. And you can see that fiscal and monetary response here. I mean, we are backing up the bus. We've already committed $2.4 trillion to the economy, and that happened within weeks of the downturn. You compare that to 2008 when we got $800 billion, but that didn't even occur till 12 months after the Bear Stearns drop, and when the economy entered recession. So we have put in huge numbers right away into the economy. The Fed funds rate in 2007 was over 5%. it took over 6 months to get it to zero last time. This time we are already there. So I don't think we can underestimate the amount of support that we have put into the economy immediately this time versus last time. So, we are talking about more, support for the economy, and I think in some ways that's good because I don't think we're going to push back the problem. We might actually be fixing some of the problems because as you can see here in the Fred graph, last time around, this kind of shows what the Fed funds rate and the unemployment rate. So you can see the unemployment rate, we've been moving down, we've had this huge spike. And this time around, we got to zero with the Fed funds rate. But once we even recovered, it stayed low for a very long period of time. And I think we're probably in store for something like that again. For our banks, the delinquency rate, you can see there's a correlation. And you notice to the right of the screen, there's a huge spike up in the unemployment rate. And we are higher today than we were in the peak of the last crisis. So it's hard for me to imagine that credit problems aren't going to emerge. We've certainly mitigated them with a lot of the actions already taken, but it's hard to look at this correlation and not suspect that problems are on our horizon. This is charge-off on loans for all commercial banks, and again, the correlation to the unemployment rate, and you can see again to the right, we've started to come down, but still above the highest point of the last recession. So I think, the point being that even though right now there's a lot of positive indicators, it doesn't mean that I think that we escape some credit costs over the next few years. So what do bank investors believe about the implications of COVID-19? Again, we daily, yesterday the market was up, but bank investors, it's been a little bit of a different story. Some of the larger banks have, come off their lows from early March, but for a lot of community banks, we haven't. Overall, the index is down as of the end of July. The NASDAQ Bank Index is down almost 30%. And the KBW Bank Index was down over 31%. So certainly investors think that there are problems on the horizon for bank stocks. So, you might ask, why is the stock market moving higher? And really what's moving higher are the FANG stocks, right? Facebook, Amazon, Apple, Netflix, and Google. The S&P 500, just as a reminder, is a market cap weighted index. So the larger market cap stocks move the index. Equally weighted, those stocks are all up almost over 35% of the year. Many of the remaining stocks in the index have barely budged. But I also, what concerns me beyond that is the stock market suggesting that we might be in this type of normal for longer? Because one of the things that it might also be foretelling is a move to larger technology stocks and away from some of the smaller business. And is it suggesting that in these types of environments when we have downturns, bigger businesses are able to grab market share quicker because of they have oftentimes a stronger and deeper balance sheet. And so what does that mean for not only us as bankers competing against larger banks, but what does that mean for our small businesses, right? Our customers. Can they afford to fight for market share, right? Just like for us, are we willing to sacrifice margin? Can we afford to sacrifice margin in order to retain market share? That is always the small business conundrum, market share or profitability. Often it's a tension between the two. And we're probably in an environment now, since most community banks are asset sensitive, that we're going to have an impact to margin, and how much margin can we give up and still hold or try to increase our market shares in our communities. So again, I'm not a very smart person, so I always have to kind of look back at what do I know and what do other people see that I probably don't. And so one of the things that I thought about as we were looking at these second quarter numbers, because not only am I the president of QuickRate, I'm also a director in a small community bank. And I'm thinking and wrestling with the idea of what, is happening. While we had a very good quarter, I know there are credit costs on the horizon. We've been trying to build our reserve, and I thought it might be worthwhile to look at what JP Morgan's doing because, they have better information, they have better models, they might have some information that might be helpful. And this is the last 6 quarters for JP Morgan, and you can see down here the tremendous reserve build that started in March of 2019. They were at just about $10 billion. Today they're at $32 billion. They've taken their reserve to loans from a little over 1% to over 3%. That puts them in the 99th percentile in the country. They haven't seen a huge spike up in non-performers yet, but they certainly think, at least from looking at this, it looks like they're preparing for those types of losses to come. And so then I thought, okay, well, what did they do during the last crisis? And so I went back, and again, these are numbers that are all available in QwickAnalytics. I went back and looked at what their reserve was back in 2007 and what kind of build did they have into 2010 and 11. And you can see those numbers here. So they moved from about 1.6 at the end of 2007. So it was lower prior to this. This is calendar year end. They were at 1.6% and got up as high as 4.28% at the end of 2009, and then slowly started to run down. But the build was only about $10 billion. And so, again, it just strikes me as they see, certainly caution on the horizon. They are taking steps to build their reserve. I can't help but think that we should be doing, well, maybe not on this scale and maybe not as bad as last time, as their numbers are not as bad as last time. I think we have to look towards that type of build. At this point, I'm going to turn the presentation over to David Ruffin, and he'll take you through the second half of our call today. Thank you. David?
Thank you very much, John. I appreciate that, and can't say enough how excited the IntelliCredit team is to be a part of the QuickRate family of products and services. At the conceptual level, what is IntelliCredit about? Frankly, it started with conversations that I had with Sean a couple of years ago that we both agreed that at the time, a credit cycle of the late teens was inevitably going to have to end. No one in their wildest dreams would have envisioned it would have been ushered in by an event such as COVID. But conceptually, what we're dealing with IntelliCredit is largely a natural segue from the sister division of QwickAnalytics, which is as robust an analytic tool on public data as you can imagine. But we feel very strongly that the heart of credit risk is also relates to the ability to mine non-public data and to understand how the non-public information is migrating within your banks. Key concepts as you begin kind of at the more macro level, you drill down to aggregate portfolio trends and then down to the loan level, if you will, using kind of a peel the onion concept. And then what other revolutionary attempt we made here was to once and for all take loan review out of the wilderness, so to speak, and instead of treating it as a one-off engagement periodically, to tie that in real time with the analytic tool that we have developed. And I think, frankly, that it has been an appropriate investment, an appropriate timing for this creation of IntelliCredit, obviously because of many of the things Sean just alluded to. So let's talk a little bit about what's going on in the current credit environment. Certainly we've got a new credit cycle on our hands that I think does require a very new game plan for credit risk management. There are certain segments already in snapback mode economically. There are some new spikes in the virus outbreak, as you know, in certain regions in the country. But I think from a credit perspective, we have to accept that the behavioral changes in various business models have been significantly stymied by this event. Restaurants come to mind that even at the even in opening states, for example, most restaurants can't serve but 50% of their so-called 100% full capacity models. There's a bit of a sugar high of COVID going on at this point. Sean alluded to it earlier, kind of the non-baseline lending activity and growth and deposits, and certainly in fees. But there's also, I think, a need to acknowledge that the advent of the PPPs, the advent of the COVID modifications and extensions have effectively masked embedded credit risk. I have talked to investment bankers in the last month or so, and they clearly say that not only because of the underlying uncertainty of credit risk, eventually that's led obviously to a bit of a stymieing of deals, but also that is exactly what I think is at the heart of what Sean talked about in terms of particularly the stock indexes for community banks. Therein lies, I think, something we do have to embrace. The publicity, the news items come largely from Wall Street. There's no question all of us hope for as rapid an economic recovery as possible. But I think those of us who've been around credit for many, many years understands there's always a long credit tail to any kind of economic shock. In other words, Main Street is not Wall Street, and we have to just accept that. We do have to understand that irrespective of the regulatory relief and the stimulus programs, that financial institutions continue not to be immune from any compliance, reputational, operational, or economic risk that we're dealing with. Again, I've said this before many times. Good news is that unlike 10 years ago, the banking industry has significantly more capital, liquidity, better risk management, short-term loan and deposit growth, and really no blame. Nobody can ascribe blame to the financial institutions in any part of it for the advent of this crisis. So therefore, we shouldn't be anticipating any kind of punitive guidance, legislation, regulatory aspects. In addition to some of the charts that Sean showed, I think these are very credit-focused. It really is kind of where the rubber meets the road in terms of credit. Estimates are that as many as 32% of a combination of mortgages and rent payments were not paid on time in the month of July. Again, Sean alluded to this earlier, but there is a distinct correlation and a clear trailing indicator in terms of the red line being 90-day past dues delinquency in commercial banks, the yellow line being bankruptcy filings, and of course the unemployment spikes in the bar graph. Again, that's a trailing indicator that we're eventually going to have to live with. One of the most interesting came, however, from a real estate group back in May, showing the real spike up in retail and lodging delinquencies in commercial real estate. Again, these are direct issues from a credit perspective that we have to deal with. I'm going to use some data now from our sister division, QwickAnalytics, to talk about some of the things we look at from a traditional credit. I spend time with board of directors on this issue many times about what are the primary issues that you can be looking at or points of measurement around where my bank stands relative to quality. You start with the inventory, which is total non-performing loans to loans, as you can see on a regional basis. Nationally, we're about 100 basis points. The Southeast, not surprisingly, probably, and the Southwest lead a tad, although it's predominantly the West and Northeast that are pretty low in the inventory, down in the 71 and 79 basis point categories. So here's your inventory of acknowledged problem loans at this particular point in time. And notice, again, there's not much of a tick up at this point. Charge-offs, you can either do one of two things. You can charge them off or you can reserve for it. Charge-offs, not an event, not really newsworthy whatsoever at this point. Another measure we take is then, okay, how are we reserving? You saw these big spike ups in JP Morgan, and the presumption is the larger banks are following suit and stacking reserves significantly. That has not happened to that degree by any means with community banks at this point, even though there's a tick up in that, as you can see. Another more traditional way of looking at that is ALL to loans. And the interesting thing of this graph to me is that the West, which has the lowest amount of acknowledged non-performing loans, actually has, on an aggregate basis, the highest reserves at this point. So I felt like that is very, very interesting. Again, this is Q2 call report data. Commodity valuations, I think, are very, very important to understand, and what that really does mean is that what is the products and services produced by any given industry. One of the issues we're faced with in this particular crisis, unlike a decade ago, is the impact on a variety of industries. In many ways, you could look back on the crisis of the Great Recession and say that was really one commodity, one-to-four family housing valuation collapse created much of that. We're now having to look at many, many other aspects of what our loan portfolios are populated by in determining what kind of deterioration is going on with different types of industry, not just, say, one-to-four family, as 10 years ago. We think very strongly that it's very, very important to begin that process of dusting off, again, your game plans around determining and quantifying your credit risk profiles. We like to start with risk grade migrations within pass. That's really, we think, the art of credit risk management, is understanding where credit begins to deteriorate long before it becomes public data that, say, QwickAnalytics would report in terms of criticized classified loans. But again, it's beginning to get at issues of where risk grade deterioration is occurring, again, within subsets of your portfolio. We talked about industries. Most banks now, of course, are tracking their loans through NAICS codes and understanding the differences in that. Vintages are important because one of the lessons we learned in the last crisis was loans made late in a healthy credit cycle, unfortunately, inevitably become the most toxic for a variety of reasons. But it is something I think you do need to understand and keep a subset of an analysis and assessment of your portfolios by vintages as well. Certainly concentrations and correlations being a kind of akin to concentrations. It wasn't just the wonderful family housing development or direct loans that frankly caused so many bank failures in the Southeast a decade ago. It was the fact that many of those portfolios were highly correlated to housing in industries related to housing. So understand not just the bluntness of a given concentration, but what is somewhat related from a correlated standpoint. So let's take a look at where second quarter shows us in terms of the traditional CRE concentrations, which of course came out of the 2005 guidance about the interagency regulators. And it is guidance, it's not regulation. It basically, as you can see on the left, is the subset of that, which is the construction development guidance of no more than 100% of risk-based capital dedicated to that. Not unsurprisingly, the Southeast, again, leads a little bit on that. The Midwest is the lowest category. There are 195 banks in the country and under $10 billion that exceed the 100% guidance in that. Southeast leads with 62 banks. In terms of the broader regulatory guidance of 300% broader-based CRE to risk-based capital, you've got in this case, the West actually leading. The national average is about 150 basis points. Again, the Midwest is only down to 100 points at about 121 basis points. 261 banks nationally exceed that. 50 banks in the Southeast exceed it. Again, that certainly does not mean you can't do it, but it certainly would put you under the scope of more regulatory scrutiny to defend your performance at a level higher than those categories. Other concentrations, and unfortunately we, in the community bank space, I think a little bit negligent sometimes of thinking that the only concentrations we need to be worried about are real estate. It's really any concentration that you may have. And here's some interesting data from what we were anticipating. I wasn't necessarily anticipating a little spike up in multifamily, but my presumption on that is that some of that came from PPP loans on apartments and rental houses and what have you. But as you can see, again, in those cases, the Northeast and the West lead multifamily. C&I, huge spike up. That's obviously, again, non-baseline, non-organic growth, but much of that will go away, presumably after some of the PPP activity. But you can see significant spike ups there. Ag, of course, is not as significant in the commercial bank space as it is in the farm credit system, but it clearly has, and we do know that in some cases we've got some regions and some commercial banks that have significant exposure in ag, which has had its stresses. So what are some of the immediate concerns of credit for community banks? Certainly most small business service industries, I think, across the board. Some could argue with the exception of grocery stores, it's probably any service industry has been at least significantly impacted. Certainly all income property, commercial real estate. We understand big box malls and large commercial office space is not necessarily the risk point of a community bank, but I would argue that a lot of the strip centers that populate the country, the suburban and rural areas, I'd say 90% of those in many cases are financed by community banks. Surprisingly, nonprofits, unfortunately, this has been under stress since even in good times of 2018-19, because unintentionally perhaps because of the 2017 Tax Reform Act, which basically de-incentivized charitable giving. And I believe it was Barron's that recently estimated $68 billion less in charitable donations were made in 2018. Just last week, a study came out that nationwide more than 500 largely private and smaller colleges and universities were showing warning signs of financial problems. And again, there's been a huge increase of lending at the community bank space to small colleges and universities, in addition to religious organizations and YMCAs and so forth, frankly, just to begin some diversification away from housing from a decade ago. Agriculture, as we said, in some spots is clearly stressed. Consumer credit quality, especially automobile paper, for particular banks that have gotten back into dealer paper over the last few years, that certainly we're still looking at about 80 to 85% of all the losses in commercial banking come from consumer purpose loans at this point. So how do we dispose of the PPPs? I know there's a number of banks that have already decided that huge swaths of them are up for sale. But I think this is the point that Sean was getting at, is once this kind of stimulus program ends, or we get some regulatory the relief that the regulators have given the industry comes to an end at some point in terms of oversight, the aftermath of what we're left with the COVID mods and extensions. And I think in some cases the artificial aspect of one state, for example, we looked at in some data, it basically eliminated all of its non-performing loans in 2 quarters because of some of the modification and extensions used against them. But that, again, those are going to have to be dealt with as we come back through. There's also, unfortunately, a disproportionate challenge in managing problem loans at small banks. Not only what Sean alluded to in terms of this massive capital that is in place at the larger banks, but there are 2 other key aspects. One, there's a significant dependence on financing real estate at community banks, which is arguably the most illiquid of all banking loans or assets. And there's a subjective kind of qualitative issue that most small community banks have to deal with. And unfortunately, you, in many cases, go to socialize with problem borrowers, and it makes it more difficult to deal with once credit problems occur. Please understand, it gets to the issue of focusing in on initial problems, migrating, showing signs of increasing credit risk in your portfolio. Don't be a victim of the line that says, well, all loans are good loans until they're bad loans. Again, that is a trap that we need to avoid, particularly now. Not keeping close to COVID-related borrowers. We have a specific tool that we wanted to share, indicate with you a moment relative to that, the COVID tracker. Not anticipating renewed regulatory scrutiny indicators that we're seeing. We're already hearing concern by some regulators that have been communicated to some of our clients that they are expecting to see some very robust problem asset plans or some type of assessment beyond just the coding or identification of these loans, beginning a process of what are we doing about them and how are we going to work through them, particularly those that aren't tied to the PPPs. Not catching up on loan review. There's been speaking of a conundrum, there's, for the obvious reasons that you couldn't travel and couldn't have large people or large groups go into your banks, or even, frankly, in some cases, being bothered within your banks if the loan reviews are being done remotely. There's been a postponement, a significant, if you will, deterioration of the scope of loan review work being done throughout the entire industry in the first half of the year. Again, regulators are quite sensitive to that. They have sent directives out making sure that banks understand that given economic stress, that's the absolute last thing you need to do, is to be not catching up at some point on loan review work. And then I think most importantly as a catch-all, just not determining, not quantifying, not describing your credit risk profile before a regulator does it for you. Again, that is the concept for IntelliCredit. We have, as I indicated before, we have the portfolio analyze, we have the smart loan review, but we also have kind of an adjunct that was developed as part of the portfolio analyze, which is called the COVID-19 Tracking, which does get to the more qualitative, if you will, tracking of these COVID-related loans in a web-based program that gives you the ability to have version control, audit records, but it also gets you away from just the bottlenecking of trying to deal with these loans and at a spreadsheet level. So we feel very, very strongly that now is the time to begin assessing, documenting, frankly, beginning to quantify the distinctions between what COVID-related extensions and modifications may still be having problems. The Interagency Guidance, which really had nothing to do, frankly, with COVID because it was initially issued, or at least open for commentary back in October of 2019, the final guidance was issued May 8th of this year. It did effectively dust off best practices in credit review risk systems on the presumption at the time that we were, again, heading to the end of the very protracted credit cycle. Now all of these issues have been exacerbated. I think, again, it would be the height of irresponsibility for banks to just presume that somehow we can just keep postponing risk reviews or loan reviews because of the COVID environment. Again, one of the things we feel proudest about is we took this loan review product, if you will, which traditionally is a standalone, some people like to call it an audit, and made it more of an interactive, in real-time partner to portfolio analysis. Going back to the peel of the onion analogy, you would be able to take the most aggregate macro data in your portfolio, drill all the way down to the most minor loan review exception finding if you use this in companionship with the portfolio analytic tool that we've done. So we feel very, very good about what we have put together to deal with what we think will be very heavy focus in the next few years of additional loan review work. I would close by just saying there are a couple of key questions that I think we do need to ask about loan review. Have you got the talent in your loan review team that are experienced enough at the heart of an emerging credit risk to get at it? That including having good verbal and persuasive skills. We're now at a point that this is going to be far beyond just checking a checklist item or documents in place or it's not in place. And this, frankly, goes to the part of, again, what kind of qualifications do you have in loan reviews? We're asking more and more of our clients to make sure that you get bios or skill set profiles of people doing loan review, because I think you're really required at this point to have someone that does understand what they're looking at. Is it in sync culturally and technically, include understanding your own corporate methodologies and nomenclatures to all other parts of the credit process? Is it relevant in real time? Again, that was the heart of us developing Smart Loan Review as a companion to the Portfolio Analyzer, but it has that real-time assessment. One of our Chief Credit Officer clients, frankly, has said this is the most efficient and the most in-depth loan review we have ever experienced, largely because of the fact that we are in a kind of a real-time clearing process. It gives reviewers and credit professionals the ability to, at any point in time, look at what's being assessed potentially as an exception. Is it, of course, truly independent? And, of course, this goes to the heart of the potential postponement of loan review. Are we suppressing loan review today in any way? Does that exacerbate more losses later? There's an old saying, as you know, in credit, that first loss is the best loss, but you never want to postpone. So I will hand this back over to Sean, and I thank you very, very much for hearing a few items we have concern about in the credit area, but we'd love to hear from you down the road. John?
Thanks, David. I'm going to take back the screen here, and there we go. Get the presenter view here real quick. Bear with me, folks. Well, I'm going to try maybe. Here is the presenter view. No, it's not letting me. All right, we're just going to go with it. So, as David touched on, what are we planning for? So, I think as he mentioned, we're entering this period of time much stronger than we did last time as an industry and individually as banks. I think that helps deal with any of the issues that may come and arise. But here we go. But I think we have to make the expectation or bake in the expectation that interest rates are going to be lower for longer this time. Last time, again, interest rates stayed low for a number of years, but they started to rise at as inflation even showed any signs, and there was real concern at the Fed about not letting it get above 2%. I think this time they're going to let inflation run. So I think we have to assume that rates will be lower for longer. If, again, looking back what happened last time, when we reached 10% unemployment in 2009, it was 5% in 2016, and then 3.5% in February of 2020. So today we are at just slightly above 10% unemployment. It's clearly going to start a slow trek down. And as we talked about at the top of this, the strength of the economy and dealing with the virus are tied hand in hand. We saw, and you can see, larger banks are establishing reserves on par with the last recession. Regional and the over-the-counter stocks are trading at percentages of book value. So clearly, caution is in the wind that we need to be mindful of. The one really positive, and I can't underestimate this the most, is that the Fed and the government are providing significant aid quicker in support than in the last recession, and that will have a mitigating effect. How much remains to be seen. A lot probably depends on how long, before we have a vaccine or we're able to get back to normal. But at least to this point, they are making a huge commitment to trying to assist not only the economy but individuals and businesses. Interest rates, what should we expect? Again, I think they're going to be lower for longer, which will mean compressed NIMs. Most of us are asset sensitive, so this will mean recovery will take a little bit longer. Credit costs are likely, are going to rise. They're probably with us at least through 2022. As David said, those are a lagging indicator, and there's a tail to all this unemployment. So we have to expect that. I know there's a lot of talk about a V-shaped recovery because of what the stock market has done. I do think there's a little bit of a disconnect. We're probably, in my opinion, something more like a square root sign where we go up and then we're sideways until we get back to both a vaccine that's able to be distributed and impactful, but secondly, that we get back to something close to normal pre-COVID of this year. So I'm always a big believer in direction. Again, I don't think we can ever really be precise. It's somewhat of a fool's errand, but I do think we always want to be or try to be where we can directionally accurate. And so, what does that mean? What gets us back to normal? The path of the economy, as we've repeated here, will depend on the course of the virus. I don't think just the vaccine in and of itself will be an immediate fix because we haven't been able to really distribute or do anything nationally to get PPE to the right people. But somehow we're assuming we'll get this vaccine to people effectively and quickly. I hope we will, but it's not clear that we will. So we'll have to monitor that. I think in today's world, are these relative qualitative factors if you think about our reserve? Are people wearing masks in your community? Are they avoiding crowds? Are they staying 6 feet apart? Are they opting to stay outdoors? These are all things that are going to impact how quickly things get back to normal. We're going to see a big, a little bit of a real-time experiment with schools going back this fall. Will we see an uptick as people move back inside as the weather changes? These are all things that are going to impact, again, the number one thing that's going to, impact the economy is the course of the virus. We're going to see all these things in real time, and we have to incorporate those into what we might expect, for our borrowers going forward. Where do you, access your current historical information? Again, absent real good data, it helps to look back and see what you've done, what others have done in the past. Again, QwickAnalytics is a great tool for that. So, as best as I can think about it in my simple mind, right, we need to review our historical provision build last recession, look at our historical charge-offs and where we went in terms of delinquencies last time. As David touched on, identify and really scrutinize areas that are vulnerable and potentially correlated to more COVID pain. Schedule and strengthen those loan reviews. Identify and review those concentrations in your top borrowers. Improve your reporting tools, and then certainly maybe look at a credit stress test at the portfolio level. Just a final few things. If you haven't looked at QwickAnalytics yet, we continue to add functionality. We've added an Excel AddIn tool that many of you may have not seen, but it does provide access beyond our interactive pages to every piece of call report information about every bank. We'll be adding very soon, hopefully by the end of the next quarter, we are incorporating more market research that will include access to Fed data. I don't know if you use the St. Louis Fed site, but they have a tremendous amount of economic information. We are trying to, through their API, build that into QwickAnalytics so you can incorporate that kind of planning and just research into identifying what's going on economically in your area, and then potentially compare that to different credit metrics as well. So we're excited about this offering that will we expect certainly by the end of the year, but hoping and shooting for it by the end of the next quarter. As David touched on from a credit and loan review, we really do think the time is now. It is, we didn't expect all of this to come about as COVID, but we did think that we were long in the credit cycle, and so we were excited to bring David on to start Interagency. So, first and foremost, we do think we've built some offerings that will leverage and build upon what we've done with QwickAnalytics. A lot of that we're taking portfolio and looking down. This obviously we're looking loan level and looking up. So we think it's a good marriage. We've tried to build it not only for it to be easy to use, easy to implement, but affordable for banks of all sizes. We don't want technology to be out of the reach of any community bank. If you remember at the beginning of the call, I said 50% of the banks are between 100 and 500 million. We think these are the types of tools that every bank can incorporate and afford and build into their operations, which we think will be valuable for them. So we would welcome the opportunity to talk to you about your situation or schedule a walk with you so you can see not only how we think these tools could help you, but also see your data. So we are certainly open and encourage you to, if you haven't reached out to us, please do. We can give you a quick demo of what we're doing. We can talk about your portfolio and hopefully show you how these tools can help. There are just a couple of questions, and one of them does kind of relate to this. Does Interagency do loan reviews? And the answer is yes. And then I would also point out, based on that question, if you have an internal loan review team, you can use the Interagency tool for your own internal loan review efforts as well. So don't limit yourself to thinking that this is only an external tool. If you do have a team doing internal loan review, we can show you how this can not only streamline and make that more process efficient, but also just capture all the good information that you are capturing at the core level today, and then marry that, as David said, with your loan review results. So we just think it's an information system that's that the time is right for it. So we certainly welcome the opportunity to discuss it with you. I'm just going to check again. If you have any questions, you can submit them. I'm going to see if there are any more. Okay, I don't see any. Just a reminder, we will send out a copy of the presentation and a link to today's recording. If you have any questions, we'll leave this screen up for you. But if not, then we certainly appreciate your time today. I know things are tough and different in the banks today, but I appreciate you taking an hour out of your day to listen to us, and certainly let us know if we can help. So have a great day, and we'll talk to you next quarter. Thank you.